I'm over $126 million in debt, but making millions. How is this possible? Let me break it down. The thing most people are trying to escape debt is the very tool that I've used to build a $200 million plus real estate portfolio. And it's the same strategy that wealthy use every single day, especially when inflation is raging and the economy is on shaky ground. You see, most people fear debt. They've been taught to avoid it. But the wealthy, we've learned how to use it strategically. It's not about being reckless with it, it's about knowing the money game. So what I'm gonna do in this video is show you how high net worth investors leverage smart debt, good debt, to build generational wealth, especially through apartment buildings, and how you can start using the exact same strategy for you and your family. So debt, the word debt for most people triggers anxiety, car loans, credit cards, student debt, etc., right? It's this weight that keeps them stuck in the rat race. They work harder just to stay afloat. And that dream, the day they can say, I'm debt free, is what's great for them. But here's the kicker. The wealthy aren't trying to be debt free. They're trying to be debt rich, to be asset rich. And they use good debt as a vehicle to get there. So what is the real threat around debt? It's not the debt that's the threat, right? It's the over leveraging. It's the variable rate interest rates. Coupled with inflation, it's not the debt that's the problem. It's the type of it. So let's talk about what's really stealing your wealth. Inflation. Every year, your dollar buys less. You see it. Cost of eggs, rent, gas, all of it creeps up. Meanwhile, your savings, it just sits there. It's shrinking. You should never have more than 6 months of reserves in cash sitting in any bank account without it moving that money into some form of higher interest rate bearing accounts or investments for you. But what do wealthy investors do? They flip the script. They use fixed rate debt to buy hard asset, especially multifamily apartment buildings. They go up in value and they use the inflation to ride that up with it. So instead of inflation hurting them, it's actually working for their benefit. While most people panic about higher prices, we're collecting higher rents, increasing our asset values and paying down yesterday's debt with tomorrow's cheaper money. So even when rents flatten out and values even go down, so long as you're not over leveraged, right, and you can keep fixed rate debt to ride through the rough waters, you'll never lose with real estate so long as you never are forced to sell the property. So there are two types of debt. There is good debt and there is bad debt. Bad debt, credit cards. You don't pay them off. It buys liabilities for you. You see it. Cars, clothes, consumer debt, consumer stuff, loses value, no ROI on it. Now on the flip side, the good debt is this. It buys income producing assets. Multifamily as one example. Grows your wealth. Let me give you an example. I'm going to break a property down and give you an example of John. So here's how my firm and other top investors do it. We use good debt. We use bank leverage. I'm going to break this down for you. So let's take a multifamily apartment building. Let's say it's a 31 unit for simple math. We're going to borrow good debt, fixed rate debt, 65 to 70% leverage. So we're not over leveraging. We're keeping that leverage reasonable on a commercial property. That's pretty typical. It's fixed rate interest rate, whether that's 5, 6%, whatever it is. We're going to borrow that money from a bank. The bank's going to give us that loan based upon the property's financials, right? The revenue generated from it based off all the expenses and everything. It's going to be based on the property, the asset's financials, not yours. So here we go. We got the bank. They're going to give us the loan. Now we have tenants in the property. Those tenants could be even you paying rent. That rent is being used to pay the mortgage, the taxes, the insurance, the expenses, and it's producing that monthly cash flow. So it's not on us. It's on the property. It's not on us. It's on the property. It would never be on you. It's on the property. The property is covering it. It's like its own operating business. It has revenue. It's got expenses and it has a profit. That's simple, okay? Let's keep going. So let's take an example of John right here. That same 31 unit property, we're gonna put some actual numbers to this thing for you. Let's say the 31 unit was $2 million. He's gonna go out and get a 70% loan. Remember, getting that loan, $1.4 million, is easier than getting a $200,000 house loan. Why? Because the bank is looking at the property. They're not looking at you. You are secondary in the process. So as long as that property financially pencils, which we show you how to do, the bank's going to throw the money out the front window to you pretty much, okay? So that's a 70% loan, low leverage, fixed rate debt. Now you have 30%. That's the down payment. Now most people get stuck right here. You're thinking, well, dude, I don't have 600 grand. I'm not expecting you to. This is how the game of OPM works. Some of your money in conjunction with other people's money come together to do these assets. Now, why would other people get involved with you? Because it gives them a good return on their money. If they're earning 15, 18, 20% a year on their money, would that not be a decent investment? They don't have to do any of the work. You're doing all the work, which is why you're going to get in the big bang. They're going to get a good return on their money, which is why they would want to get involved with you. Even a seller would want to finance it with you. This is why this works. It's a business. It's not a residential property. Take your mind out of that and put it into the business aspect. This is why this works. There's more pie in the game. Okay. So $600,000. Now you would not be coming up with that. Your responsibility as the person running the show, i.e. the syndicator, the sponsor, the general partner, all the same thing. So when you hear those terms thrown out, syndicator, sponsor, general partner, that means you. You're the big honcho running the show. So you're not coming up with the 600 grand. You're going to come in, John's going to come in with about 10% of that. That's 60K. Not 600 grand, 60K. It gets a little bit better. I'm going to show you in a minute. The seller, in this case, seller finances the property or a portion thereof it. So they're going to come in with that 600,000, they're going to come in with 350,000 of that 600,000. Okay. And then now you have FF. That's friends and family. Could be people in your network. Heck, could be people in our network. All the above. That's the OPM game. Don't worry about who and how and what and when and up, down, left, right. Focus on the deal making good financial sense in terms of a percentage return and some metrics. We'll get into that later. But you just have to understand the deal will drive the money. It'll attract it in. Okay, so focus on the deal. But this is how structurally it would get broken down. And you're only coming out of pocket 60K, but it gets even better. Because for putting these types of deals together, the hard work that you're going to do, you get what's called an acquisition fee for doing that. The general partner, the sponsor, syndicator, that's you. You're getting an acquisition fee, typically 2 to 3% of the purchase price. So 2% of $2 million is what? That's $40,000. So $60,000 comes out of your pocket. That goes into the investment. You're getting a check back literally within a week of closing the escrow on this thing for $40K. And it's all built into the cost of the deal and the closing cost of the deal. So don't worry about that. So you're out of pocket really $20,000. And you have control and ownership of a 31 unit, multi-million-dollar apartment building. Bada bing, bada boom. Let's keep going. So let's walk through this, how this value is going to increase and how good debt helps you do this. So John, 24 months later, so you buy the property now, fast forward 2 years after you've done all this cool stuff to it, and we're going to get into that. That same 31 unit that you bought for $2 million, after increases in renovations and some other things you've done, you've been able to increase the rents through renovations and normal inflation in the market, rent increases, all these other things you'll be doing, adding value. So you've raised the rents $250 a month times 31 units. That's $77.50 per month in additional revenue. No additional expenses, additional revenue. That's $93,000 a year and increased what's called net operating income. That's revenue. So to establish value on a commercial asset, it follows this simple formula. The value, V, equals the net operating income, annualized net operating income over what's called a cap rate. Don't worry about the details of a cap rate. You can Google that. You can chat GPT it. You can do whatever you want. Okay, it'll give you the details on what a cap rate is. It's essentially your cash on cash return without any debt. But we'll get into that detail later. There's other videos I do for you that'll break that down. But NOI over cap rate. So for this particular property, focus on this for a minute. You took the NOI, you increased it $93,000 a year. Okay, I'm going to show you the value increase here. $93,000 a year by bumping rents $250 a month. By bumping rents on the 31 unit, an average of $250 per month, you increase the net operating income $93,000 a year. We're going to take that over a pretty industry average 6% cap rate. So $93,000 divided by 6% gives me a value increase of $1.55 million. And the tenants were paying it the entire time. They were paying the mortgage, they were paying the insurance, paying all the expenses, paying everything, and giving us a cash flow. So we have cash flow, and then now we just increase the value of the property and put $1.5 million into our pockets simply by increasing the rents $250 per month. You see how the game works, and it's all against fixed rate good debt. So this is how good debt works. Let's have a little bit more fun with it. So John, like I said, he's the syndicator, he's the sponsor, general partner, all the same lingo for you. So to kind of show you structurally how this thing breaks down. 31 unit deal, he's the general partner, that'd be you. You have limited partners. These could be the seller financing it, could be other friends and family, could be people in our networks, all the above. Don't worry about that side for a minute, but just kind of understand the structure. So John's going to get 40% for only bringing in 10% of the money. He's getting 40% of the deal. Now keep in mind, he has 100% control, decision-making, power. You're running the day-to-day. You were the head honcho running the show. You have all the shots. You're calling it. You have 100% control of the deal, 40% of the profits, the cash flow, everything. 40%. And you get a bunch of fees and stuff in that too for running the deal. So this is why it's so valuable for you to run this and do this. Okay, you're not doing this for pennies. You're doing it to make millions. That's why you're playing in this game and learning how to run the show. So 40% of the cash flow, 40% of the profits. You're getting your acquisition fee of 40 grand. You're going to get what's called an asset management fee as well. That's 2% of the revenue every month. You're going to get what's called a disposition fee. This is for when you refinance the property or you sell the property. For you as the general partner, i.e. syndicator, sponsor, all that stuff, that person gets additional fees. That's all standard stuff built into this process of multifamily. When you buy a multifamily apartment building, you're getting paid 5 to 8 ways. When you own a multifamily apartment building and you're running the show, you get paid big, big money for doing great things. This is why this works. You're solving big problems for people. So additionally, your money, right? John's money also gets to play in the limited partner side of the deal because you're your own investor in your own deal. That's the cool part. You get to double dip. Okay, you get to double dip. So you're getting your percentage of the 60% on the other side. Plus you get a piece of what's called a preferred return. Listen, I understand this may be a lot. I get it. Don't worry about that. Just let it kind of absorb in. You know, lots of videos you can watch. I'm here for you. You can watch all my other stuff on my YouTube channel. I would love for you to watch this. We're going to break this down step by step. So the seller, remember the seller? He could be financing this thing for you, right? Remember the seller here could be financing it for $350K. Then you have friends and family in it for $190,000, as I mentioned right here. Okay, so they're all coming in here. So you got the seller in here for $350K. Then you may have another investor in here for 50, then 100, then maybe 150, another 75, whatever it is. And then John's in here for 60K. And that's how all that equity is going to break down. And that's how it's going to be put together. Meanwhile, you're controlling the general partnership side and you're getting your piece of the limited partnership side with all of your other partners and friends. And that's how it runs. But you're controlling 100% of the deal. You call the shots. You make all the decision. Okay? So now let's walk a little bit further, kind of show you how cool this is when you do a refinance and allow that good leverage, the good debt to benefit you. So that today, that 31 unit is $2 million. You have a $1.4 million loan on it. Remember that? That's the loan we took out on it when we bought the property. We brought in $600,000. I just showed you that. So total of $2 million. Fast forward 2 years ago, right? That same 31 unit, remember we increased the rents, $250 per unit per month. That helped us increase the value from 2 million. We added $1.5 million and change, right? We took it from 2 million, added $1.5 million and change in value. So now that value is $3.15 million. Watch how fun this is. Once again, now we're going to refinance the property. So this is where you hear this cash out refinance game work. 70% loan goes on it. Keep low leverage. Remember, low leverage, fixed rate debt, 70%. You have 30% equity in this thing. That's amazing. It's pretty awesome. So now you're going to get a $2.2 million loan. Fixed rate debt. You also have an additional $945,000 increased equity on top of that. So that $2.2 million loan, watch what happens. That loan is going to come over here and it's going to pay off the existing loan on the property. It's going to give you and all of your partners and everybody $600,000. It's going to pay you guys back all your initial investment into the deal. It could even pay off your investors, maybe some of it. You could do that. And then you could wipe them out. And now you have 100% of 100% of 100% of everything. And you leverage tenants, OPM, everything else to gain control. And you went from having 40% now to 100% if you paid off your investors. That's a game you can play too. But you kind of see how this thing works. It's unbelievable when you really understand the value and the leverage of money and how this game works. We acquire apartment buildings with long-term fixed rate debt, often locking in financing for 10 plus years. This means our largest expense, the mortgage, is predictable. Even as everything else may be inflating up, down, left, or right. We let the renters pay it off. The tenants cover all of our mortgage, taxes, insurance. produces additional cash flow on top of that. So we're not paying the debt, the asset is. We're riding the inflation wave. Over time, rents go up, property values increase. Meanwhile, our loan payment is fixed rate, stays the same. So we're literally building wealth through debt using inflation as our tailwind. This is how we scale portfolios from 100 units to 1,000 units and beyond without raising the risk unnecessarily. So real wealth strategies used by the elite. Let's go even a level deeper for you. The ultra wealthy use these 3 strategies across their entire portfolios. They scale with OPM, other people's money, like I was showing you. We don't use our own capital for everything. We raise capital from investors. We combine it with maybe seller financing, debt. We scale faster while preserving liquidity. This is how you go from one property to an entire multifamily empire. So let's talk about tax advantages. We're not going to get into all that today in the video, but depreciation, bonus depreciation to help offset massive tax gains you may have even in your daily job, let alone capital gains from investments. Cost segregation. So not only do we earn cash flow, but we often pay little to no taxes on it. So debt amplifies those benefits without triggering income tax. So you know how they say there's 2 guarantees, death and taxes? We say our strategy is simple: buy, borrow, and die. Yes, this real strategy, buy appreciating assets like large apartment complexes, borrow fixed rate debt against them for liquidity, that's tax free by the way, and then when you pass on, your heirs, they inherit a stepped up basis on the properties, wiping out taxable gains. This is how billionaires pass on wealth without the IRS taking all of it. So you have to understand, debt is not the enemy, stagnation is. Look, we've been sold some false narrative. The goal isn't no debt. The goal is controlling the right kind of debt. Good debt, not bad. The kind that builds equity, increases income, and protects you from inflation. So when used correctly, debt is not a burden. It's a lever. It's how you get off the hamster wheel that you're on right now if you're in a 9-to-5 W-2 type transactional hamster wheel. It's how you build true freedom. This is how you're going from working for money in your time, right, spent for it, letting your assets work for you. So do me a favor, if this shifted your mindset at all on debt, even just for a little bit, drop a comment. Let me know what stood out to you. The more you let me know, the more content I can create specific to your need. So please like and comment, save this video so YouTube knows you like it, and we'll share it with more people just like you. Don't forget to subscribe for more real strategies on scaling your wealth. And if you're ready to go deeper, check out the next video, how single family flips and rentals lead to multifamily deals. You'll see the videos right here in. Take care and happy investing.